Welcome to our next Hogman Farrell video blog. It's been a little while since we've done one. As you're aware, we've started using the Financial Knowledge Centre, so you're receiving those newsletters and those videos, and we felt like it would be inundating you with too much information if we hit you up. We've also not been super well. I've had a week off work this month. Sorry for the delays if you've been trying to get through to me. Anyway, we're here now.
Slightly nasally sounding, but we're here together.
We wanted to just touch base with the recent share market volatility around the globe, and particularly in Australia. So we just wanted to touch base with you, give you some understanding about what is perhaps causing that, and whether it's a genuine fall that needs to be taken care of, or whether it's a buying opportunity going forward. I'm going to ask some questions. Steve's going to give us some answers. Maybe. So, Steve, financial markets are red everywhere.
Yep.
It's bad. Should I take all my money out of shares?
Definitely not. So yeah, I guess in the last week in particular, overseas markets and the Australian share market have taken a bit of a battering, and primarily from what we can tell, it's a reaction to the Chinese share market. Both the Shanghai and the Hong Kong indexes are down quite dramatically, and that has sparked global share market falls. And
is that because the Chinese share market's such a big part of the global market?
No, it's more because it got really out of control. So in the last 12 months, the Shanghai index got up over a 120% rise, and there was a little bit of speculation maybe from the locals, and a bit of kind of opportunistic greed, and that over the last couple of months has started to unwind, and in the last week in particular has had some pretty sharp falls, down about 40% now since those highs, which is quite dramatic, as you can imagine. But you know, in perspective, it's a very volatile market with a lot of speculation, and you know, maybe even call it gambling somewhat.
So is that reflecting the Chinese economy? So the Chinese economy is going to stop and go backwards by 40%? Is that?
Yeah, look, I mean, no, absolutely not. So the fundamentals of China are definitely changing. We're seeing growth come out of China slowing from in the 7s to potentially in the next year or two into the 6s % per year, and that's really to be expected as they transition and mature their economy. On a gross basis, it's, you know, I think it's either the first or second largest economy in the world now, and it's just been growing at gangbusters, and it's a rate of growth that can't continue. But the fundamentals are still quite solid, and there's a lot of, you know, fear-mongering around the collapse of the Chinese economy, but really what it is just a slowing of the growth to more realistic levels, and quite separate to the share market.
So China, as an economy, is still growing. It's not in a recession. There's no Chinese economy problems. It's transitioning from an old, like it's been through sort of an industrial revolution, and so it's just changing from that. So we shouldn't compare what's happening on the Shanghai Stock Exchange to what's happening in the Chinese economy.
Absolutely, and there are pockets in the in the economy in China that have had problems. They've got some issues around their property investment and their over infrastructure in a few areas, but that's all kind of manageable. They've also recently gone to a more market-based setting of their currency, which has thrown a few wobbles into the market and a few uncertainties as how that all should play out. This is the first time really in history that they've allowed the market to have this kind of influence over their currency, which was previously pegged by the government to the US dollar. So that's made a few differences as well.
But you'd expect to see some volatility with that. When Australia floated against the US currency, we suddenly went through a period of volatility, And since then, I mean, we've been up at $1.15, we're now at 70 cents. So the Australian dollar is as variable as...
Absolutely, and the Chinese floating of their currency is nowhere near as dramatic as what Australia's done. It's a much more steady and slow process. It had a quick blip of 1%, which is relatively high when it first started, but they're starting to get on top of the mechanisms of that, and it's still a controlled environment. I mean, the big 5 banks in China who set the currency rate for China are all government owned, majority government owned. So the government still has its finger on the dial. It's just allowing a little bit more freedom where they're not actually directly setting the rate.
So China's been the share market's been falling. Why has that made the US market fall? Why has Australia fallen by over 15% since April?
Yep, it's really just a fear of contagion. So, you've got the idea that all these markets are interlinked and one share market influences the next. And there are, particularly in Asia, there is an element of contagion between different markets where a fall in one market will lead to a fall in the other. But the fundamentals of what the share markets are supposed to be based around are quite different in China to a lot of Asia and Australia and the US. So it's really ends up coming down to a little bit of caught people by surprise, a little bit of fear and greed. There was some greed, now there's some fear, and you've got an overreaction. So our outlook is that the Australian economy, the US economy, the Japanese economy, all of which where their share markets have taken a hit in the recent days, are all fundamentally no different to a month ago, and we should see medium term those markets start to come back to what we consider more reasonable and fair value.
So are you kind of telling me it's a good time to buy?
Well, if you've got some cash on the sidelines, absolutely. I mean, we just dipped below 5,000 points on the Australian Stock Exchange, the ASX 200 this morning. We don't know if it'll stay down there, but that's very cheap at the moment. And you're seeing that internationally as well, quite a few opportunities. Obviously, if you've got to move money from one asset class to another, then that's a bit of a different story. But
if you've got cash,
if you've got excess cash and you've been thinking about getting invested, thinking about putting more across to these growth stocks, now might be the time. Absolutely.
So really, what you're saying is I shouldn't be too worried because the fundamentals for the Australian economy haven't changed. China is going through a period of slower growth, but it's still growing, and so I should remain, if I've got a diversified portfolio, these are just parts of having a diversified portfolio, one of the reasons why we have a diversified portfolio. So I should just stay calm and carry on.
Yep. So the other parts of the market, the bond markets, our alternative investments are all holding up as you'd expect, and if you have a properly diversified mix, then you won't be feeling all of the falls in the share market, and it's just paper falls at the moment. So if you don't do anything, don't panic, and allow things to bounce back, which they invariably do. It's a factor of several centuries of share market returns is eventually that they do bounce back, and we expect this bounce back to be probably pretty quickly because, as I said, we've just gone through a reporting season. The fundamentals are still pretty good. There's not a lot of unknowns. Things are just ticking over. So we expect the share prices to come back to a more reasonable level relatively shortly.
But if our clients want to make a phone call, we're available.
Of course.
Excellent. Well, thanks for listening. We hope you found that somewhat informative and somewhat calming. If you want to give us a call, please do so. We're available to talk to you. Thanks.
Cheers.